Hello, traders. Again, with recent things happening to Doge and other cryptocurrencies as well, I thought today would be a really good time to do an episode on how to accumulate more of a spot position through using a little bit more of unethical tactics. So today we're going to be covering momentum ignition. And it's an interesting strategy. It's high risk, high reward, but it's something that happens really on every market that I know of all the time. So without further ado, let's dive into that. Momentum ignition is a way in which market participants are forced into taking certain actions because of an increase in volatility. Basically, what occurs is when price reaches certain areas, many stop losses and liquidations are triggered, which fuels further volatility in that trend direction. So why does this matter if it's a normal component of markets? Well, let's say that there's a coin and it has an open interest amount of just $1 million, and you hold $200,000 worth of the open interest of that coin, and the 24-hour volume is like, let's say, 500K. We know that there aren't too many people trading it, but imagine that you think that a lot of people recently bought. A lot of these people who bought are putting their stop losses right below a support level. What do we do? Well, it depends on your moral leanings, but what you could do is try to sell up to the point where you trigger many of those sell orders that those traders have placed, which is going to cause the market to dump, and then you buy after all of that liquidity has been triggered. So if you do this and, like, let's say you sell half of your position, which it would be 100K at this point. You sell 100K, and let's say that price goes down 20%, and then you're able to buy 20% lower. Well, by doing that little system, you just increased your overall position by 10%, right? Because we used half of our position, market fell 20%. Your position just increased by 10%. So now you hold more of that coin. So let's go look at how that really works in practice and not just in theory. So this is Doge. And just look here. Where do we screen for? Well, more importantly, what you want to look for is right below support levels and right below psychologically round numbers, such as like the area right below 0.5, the area right below 1, the area right below 1,000. Basically places where you think that a lot of stop losses are likely to be hit. Now, if you want to know, well, where are all the potential buyers and where are all the potential sellers when you're looking at a range? Typically, in a range, potential buyers will be here because this is where any untriggered liquidations will occur. This is also where any buy stop losses will occur from shorts. And then also, people who are late to the trend might just buy this up. So there's a lot of potential buyers here. Well, where are all the potential sellers in this kind of situation here? Well, funny you ask, because I might have an answer. Right here is about where a lot of potential sellers are. This range is big because we also have a round psychological number of 0.05. So I would assume that with this kind of range right here, I have a bunch of potential sellers here. So if there is a guy who holds $10 million worth of Doge and price begins to trend down, he could begin market selling, hitting the bids as hard as he can when the bids get lighter, meaning that there aren't as many bids, hitting them with the intention of forcing other people to sell. And then he buys back a lot cheaper. And if you do that successfully, you're going to just continue to accumulate more and more of that token. And that's exactly what happened here. You can see what was the kind of reaction the market had. Well, we know that open interest fell. Obviously, open interest fell like a fair amount. Open interest actually fell lower than any amount it had been during the range, which means that there are now less people in open positions than there were in this range, meaning that people are really seriously getting forced out. We also have a pretty large $8 million liquidation. So clearly this sell-off was quite successful I don't know if this had happened because sometimes these things happen naturally, but if this was orchestrated by like one guy, let's say who holds $20 million worth of Doge, he could begin trying to sell. And then the very second we hit around 0.055, he's fine. Because then the sellers just panic, then stop losses get hit, liquidations get triggered, and then it just cascades into more volatility to the downside. And you get that kind of wick, especially when we go right below 0.05. Well, clearly, a lot of traders had their stop losses at. Why are there more typically potential sellers than potential buyers? I'm going to give you guys a little challenge question here. A hint, we have derivative markets, we have spot markets, and we have options markets. what does that tell you typically about what kind of market participants we have? So if you have this kind of formation where you know that there's a bunch of potential buyers here and a lot of potential sellers here, why do you think that typically, let's say, the potential sellers are more in number? Like, this is blanket. This is, of course, not true in every situation. But what do you think the reason is? I'll give you guys like 2 or 3 seconds to try to think about the answer. One answer is that in a spot market, you can only hold one position. That's a long position, right? Unless you use margin. But a lot of people are using spot markets in Robinhood for crypto or for just Coinbase, not on margin. They're buying these cryptocurrencies, then they put their stop losses right below numbers that they think if are breached, the market will just tank. And because they do that, there's just a lot of potential sellers out there. Potential buyers sometimes can be fewer in number because, I mean, potential buyers can be quite high in a cycle of greed where a lot of people are just like rushing to buy. But typically what I notice is that this strategy overall as a whole, if you do it for a spot position, it's going to probably work better. I mean, I'm not advocating anyone does this. Please don't do this. But if you want to accumulate, if one wanted to accumulate more of a long position, it's probably easier to do this way than it is to try to accumulate more of a short position at good prices. All right, so now let's go into one more example on Doge. Then we're going to switch to screening and also scanning for more. So now we can see what's going on here. Well, what I see is that we have that, this is a beauty. We have the 0.04 level that has not been pierced yet, meaning that any stop losses right below that point have not been triggered. So what would a whale do here? Well, what a whale would do would probably be to ignite momentum ignition. If the price goes to 0.04233, it's probably potentially worth it for him to maybe sell off, or her, or they, or the bot, to sell off, let's say, 10% of their holdings. Let's say they sell off $3 million or $3-4 million worth. And they do that not through just one massive order, which they could, or you could. But what they do is they do $200,000 here when the bids get weak, meaning there aren't many bids near current price. Then when the market falls and they think that the market might rise a little bit higher, they slam it again, slam it again, slam it again, and they keep hitting it until they trigger the momentum ignition to just erupt. And that's exactly what happens here. Watch this. It's not like dramatic. I mean, I was kind of setting it up for it to be a lot more dramatic than it is, but you can see that price goes right below 0.04, scoops up a lot of stop losses, hits some liquidations, but not really many to note, to be honest with you. And then the price just rises, a lot higher like that. Okay? And here's the current price of Doge. I would say not. If one was to do this, I would not recommend doing this on a cryptocurrency that has a massive amount of 24-hour volume and open interest, because this kind of strategy is the bigger guys preying on the weaker guys, preying on the small. And it kind of goes back to my example before of if we have an open interest of only $1 million on a specific cryptocurrency, then someone with 1/5 of that open interest has a lot of power. And they can abuse that power by trying to trigger other people's forced sellers. And that's where this comes in. So if we take a coin that, let's say, has less of an open interest, less of a 24-hour volume, this is through Binance Futures, by the way, all this stuff is. So if we look at, like, let's say, okay, I'm going to go to the very bottom to get some coins that might be interesting. RLC. So RLC is only 1.2 mil, 13 mil, 24-hour volume, SKL. RLC is not something that, like a bunch of people trade. And that's why, like, let's say, yeah, and here's some. You can see with this kind of like jerky all over the place movement that there's clearly something going on here. But what I want to focus on is round numbers. I love my round numbers. Round numbers being 1. Ooh, that looks very, very interesting, if you get my drift. Like potential momentum ignition. I'm trying to go back to the point where, price was near 1. Yeah, how far back do we have to go to get to? Okay, I think I kind of can see what's going on in this market, and this is the kind of pattern that you'll absolutely see when momentum ignition is occurring. You just see those consistent sell-offs like that, and those consistent sell-offs happen because someone or a group of people could just be spamming market orders every X seconds or X minutes to kind of ensure that the market just continues to sell off. And they do this with the risk of the market rising and them getting left in the dust. But the great benefit is that they can ignite a lot of momentum ignition. And let's say that someone did this, and the current open interest at this point is about like aggregated open interest. This is not just Binance. The aggregated open interest is nothing here. It's only about $800,000. It says by my math. Or actually, wait. It says here it's about 1.2. So it's really not a lot of money, all things considered. So this is only about $1.2 million worth of open interest. So if someone holds, like, let's say $500,000 at spot, you know, what they could do is just begin to slowly sell off. They slowly sell off. And yeah, and you can even see that the sell amounts here aren't even that much. Like if you look here on Binance Futures, $27,000 here in a 1 minute candle to get that kind of sell off. 27. Wait, what? Oh my God, look at that. Yep. Oh, okay. That's too nice. That's too good to be true. Guys, look here. The volume here is 27.498K, right? What's the volume here? 27.261K. I mean, like these are like identical sell volumes. So there might be something going on here. Look at that. I mean, I'm not just picking out 27 as like an interesting number, but look at this one too. The volume amount here, you can see right there, that's what I'm looking at and talking about, is 27K. And then look at that. So it seems like someone was only selling off like really not that much. You know, this is not like a lot of money. $27,000 in sells here on a futures market. That's not a lot. But that's all it took for the market to go lower. So this could be a seller who only sold off, like, let's say $200,000 worth on a futures market to try to depress the market so that they could buy back lower. So let's say that the average price they began to do this momentum ignition, the average price of where they sold, let's say, half of their position at spot is like, you know, around from here to here, because they would probably stop selling maybe around here and let the market kind of just take its course. Yeah. So let's say they stop selling here, but the average sell price being like here for doing this kind of amoral strategy, and then they just buy back on these dumps right here. They're picking up about 3% more of RLC before it rises. I mean, that might not seem like a lot, but it adds up, especially if it's like I hold $1 million worth of this coin and I can just pick up 3%. That's $30,000. Now, you might be wondering, well, why can't I do this in a derivatives market? Why can't I do this in a perpetual, or why can't one do this with a perpetual market or a futures market? Typically, I'd say this works better with spot. That might sound weird, but the benefit is that if one was to do this, let's say that one was to do this and they do it with a spot market where they hold, let's say, $500,000 at spot if they have that much money of some cryptocurrency that has a market cap of only like 15 mil or like 10 mil, like really not a large market cap. And they begin to sell off, like, let's say up at 500K, they sell off like 200K worth, and that's it. And they buy back lower. That kind of strategy is good because if the market does rise, they're still long $300,000 worth of that cryptocurrency. So yeah, they're missing out on the potential profit, of course, by trying to do this strategy, but they're not going to get liquidated and lose everything, right? Well, you might also say, what if it goes too well and the market just completely tanks and their momentum ignition is like a little too successful? Well, that's why those traders might want to do those strategies only on coins that they believe in, that they're more like medium term invested in, or invested in for more the longer term. Okay. This lighting's hilarious. let the darkness consume me, basically. Like, do you see the way the light's hitting me? It's like Anakin Skywalker turning to the dark side. But no, I'm not. I'm not Anakin. All right. Little Star Wars reference there. But yeah, so let's do one more example on this just to kind of see what this looks like. And I'm going to continue using Binance Futures. You could look at spot markets, but I just want to look at open interest and liquidations, and that's why I use Binance Futures. So another one here would be, this lighting is just too funny. I'm going to have to keep making comments on it, to be honest with you guys. So let's look at Ocean. I haven't looked at this one yet. Yeah, it's right here. So let's see how wacky this guy is. It's wacky. And that, oh yeah. What's going on here, guys? This is, okay, so we have a quiet range here with open interest building. This is so perfect. So perfect for a trader who wants to do momentum ignition here. When you get just a tight range with open interest rising. Open interest rose by not a lot, but the percent it rose by, I think, like 10% maybe? what was this, like 8%? So there's 8% more positions here, and this guy knows there's probably a lot of stop losses like right below the 5.3 round number. So if we look at the potentially orchestrated sell-off here and massive drop in open interest, this massive drop in open interest could be two things. One, the one who's doing momentum ignition is closing up part of the position. Well, they might be doing it at spot, but if they did it with perpetuals, then yeah. Or two, more sinister, this massive drop, not massive drop, but this drop in open interest is because people are being forced out of their positions via liquidation and via stop losses. So people tend to get comfortable when ranges kind of just range for a bit, and they kind of get used to volatility. Because of that, they don't expect a massive burst of volatility to stop them out. So they might be comfortable putting a stop loss like around 0.053, maybe right below, maybe right above. And then what we end up seeing here is this guy, like let's say that this open interest is really tiny. It's only about $2 million. Let's say that this guy has 200K. So 10% of the open interest on Binance futures of this coin, 200K at spot, of course. And this guy begins to sell off, let's say, of that 200K, he gets really aggressive and he starts to sell off $150,000 worth to try to buy back lower. He sells off $150,000 worth, and let's say that he clearly, I mean, I think it's kind of clear that it happened around from here to here, and then it doesn't really make much sense, I think, to keep selling here, but let's say that he sells all around here with an average price of 5.4, perfectly reasonable, and then he buys at an average price of 5.3. Again, that's perfectly reasonable. So what is the potential pickup or profit? What is the potential profit that this guy is making if he does this? Well, that is a pickup about like 2%, which again might not seem like a lot, but it helps. Like it really does help. You're basically able to force people to sell so you can buy back cheaper. This can also happen to the upside, but it's just not, I don't know. It's just a little bit tougher to the upside because you might say, well, how about you do this but to take profit? You try to force the market up to try to take profit. That's a pretty dangerous strategy at spot because if you just continue just hammering buying at spot and the market doesn't reach that level where you think a lot of people are going to be liquidated, shorts will be liquidated, and people will be stopped out, and greed will take over. Greed will beat fear. If price doesn't reach that area, you just bought hundreds of thousands of dollars worth or millions of dollars worth at spot. And if the market falls, you're kind of just in a trap position. So that's why I would say this kind of strategy works better for just accumulating and picking up more of the cryptocurrency rather than, trying to reach a profit target. And again, one could do this in derivatives, but it's so dangerous to do that. So dangerous. Because if you hold, like, let's say, actually, I kind of take that back. It's not as dangerous to do this if you are net against the way that you're trying to ignite. Meaning, if you're in a net long position of 400K it's still dangerous here. It's still pretty dangerous, but you're in a net long position of 400K and you begin to sell off, like, let's say 200K worth, and you're already deep in profit. And you start to depress the price a little bit. If the price keeps falling, you could just keep selling off to make sure you don't get, like, killed or liquidated or stopped out. But if the price does fall, like, let's say 10%, you can pick up your futures position again 10% lower. The issue with that is that, this is more of a medium term to, I'd say, longer term strategy for profit, for just accumulating more of a coin. This is not a strategy you probably want to do for intraday trading. One could try, but it just seems really risky to do that. And that's why doing this in a spot market is probably the preferred method. And the kinds of cryptocurrencies you'd be looking for are cryptocurrencies with building open interest, rising open interest, but still a cryptocurrency that doesn't have a lot of open interest. So it's still relatively small. A crypto with a decent amount of 24-hour volume, but not too much. Preferably one that has a decent 24-hour volume. And then what you want to look for is average trade size. So if you see that the average 1 minute volume candle, like let's say on Binance Futures, is $10,000, you could try to begin, not you, but one could try to think, hey, I have $300,000 here at spot. What I can do is I can begin to sell off $20,000 per 1 minute candle, trying to get the price to go below, let's say, the price of 1, because it's going to ignite a lot of stop losses and it's going to hit a lot of people's liquidations. And that's going to allow me, through the futures market getting depressed, that's going to allow me to buy back at spot at a much cheaper price, which is going to give me better profit. So this is kind of the monopoly strategy, the one of buying up properties and, you know, I don't know, charging rent when people land on your property. So that's momentum ignition in a nutshell. I've talked about this 2 other times, but I wanted to talk about it again in 2021 because it's a strategy that happens all the time. Whether it's natural or unnatural, we don't know. But if you're interested in strategies like this and to learn more about how these things work, you can check out my trader course or my gravity course. Both talk about something similar, but my trader course uses more indicators that we talked about today, whereas my gravity course talks more about price action volume and dynamics of that with the whales and those who hold a lot of a cryptocurrency. And those will be linked below. Hope you enjoyed this video. Be very careful, like just trying to do this on a whim. This strategy is one that's a little bit amoral. It's also because you're trying to force people to lose money. Basically, it's a little bit amoral, and it's also one that is high risk, high reward. But if one were so inclined, and one were looking more medium to longer term, and wanted to keep picking up more of a cryptocurrency and accumulating a larger position without pouring in more capital, this would probably be the way to do so if they felt like this was okay with their moral standards. All right, that's going to be it for this video. If you have any questions, you can message me on Discord or on Twitter. Happy trading.